Did you see that? The Bank of Canada cut rates, first time in 6 months, but they didn't do so cheerfully. They weren't loud and clear, just risk ahead. If you're a homeowner, buyer, or just trying to make smart money moves, you need to understand what's shifting. Because this isn't just about cheaper borrowing, it's about where the economy might be heading and how it will hit your finances. I'm Thuc, your money guy. With over 10 years helping with mortgages and investment, I'll walk you through why the Bank of Canada cut rates, what warnings they flagged, what this means for you, and the smart play going forward. Key fact. Let's start with what we know from the recent announcement. The Bank of Canada dropped its key policy interest rate by 25 basis to 2.5%. This is the first rate cut in 6 months. Reasons: weakening job market, reported over 100,000 job loss in recent months. Economic contraction in Q2 around 1.6%. Inflation easing somewhat, and concerns about trade tariffs hurting export. They also signaled readiness to cut again if risk fragile. Why cut rates now? Bank of Canada is seeing two big risks hitting at once. Labor, jobs, unemployment is rising. More people losing work or having hours cut. Consumer confidence drops. This hits monthly payments, home affordability, everything. When people lose income or feel insecure, they spend less. That slows down the economy. Inflation has eased and producers seeing less upside. Inflation is still above the Bank of Canada's core target, but some price pressures are cooling, especially from trade disruptions and supply chain constraints. Tariffs and trade tensions that were heating up inflation are easing in some respects. That removes part of the upward pressure. Risk of economic contraction, export decline, trade uncertainty. With trade uncertainty, tariffs, weaker global demand, Canada's export sector is under pressure. Export falling affects GDP, business investments, jobs. Consumer spending is also at risk due to rate heaviness and inflation. So Bank of Canada is balancing. Letting rates stay too high risks dragging the economy into recession, but cutting too fast risks stoking inflation. They chose to ease slightly now because they see that latter risk as somewhat manageable, or at least they believe inflation is trending downward. But here's what many miss. Cutting rates doesn't help everyone equally. Let's look at who wins and who's in trouble, who benefits and who gets hit. In my experience, these rate moves have very different effects depending on what stage you are at: renting, owning, renewing, or buying. Homeowners with variable or adjustable mortgages, or those renewing soon, their payment may soften, or at least future payments may be less of a shock. Buyers who have been sitting on the sidelines, lower rates sometimes increase qualifying power because mortgage stress tests depend on projected rate paths. Businesses sensitive to borrowing costs, especially those who delayed investment because of high rate, and the fixed rate mortgage holders with long terms locked in at higher rates can't immediately benefit but could when renewing. Those with tight budgets, even with rate cuts, inflation and living costs, groceries, utilities, energy continue to pressure monthly cash flows. A rate cut is helpful, but not magic. Businesses, housing, builders, some projects might stall. I had a client renewing their fixed rate in early 2025 at 5.5%. Even with cuts, they might only go down to 4.5%. It helps, but if inflation or property taxes go up, that saving gets eaten quickly. What's uncertain? Warnings Bank of Canada gave: job market deterioration, not just unemployment rate, but weakening job growth, hours worked, layoffs in key sectors, trade and tariff risk, supply chain disruptions, export problems, costs of imports rise, corporate profits squeeze, inflation pops back. Inflation expectation: if people expect inflation to stay high, wages demand go up, cost pressures stay. Bank of Canada worried. Bank of Canada is worried underlying core inflation is too sticky. Household debt: many Canadians are highly leveraged. Rate cuts ease some pressure, but debt costs remain high. If rates spike again, many households are vulnerable. Global factors: weak growth, energy prices, Canadian dollar movements, trade disagreements can worsen inflation or hurt exports. If you ignore these uncertainties, you could make financial choices that backfire. So what you should do now? Let's get into strategies. If this video is helping you, hit the subscribe button right now. I make videos every week breaking down money, mortgages, and housing so you don't get caught off guard. Let's stay smart together. So what this means for mortgages and housing. Here's how this rate cut uncertainty affects mortgages and housing. Mortgage qualifying. Stress tests might ease somewhat. If Bank of Canada signals more cuts, lenders may adjust what rate they assume, fixed versus variable. Variable rate holders may see more relief sooner. Fixed rate holders locked into high rates will still need to wait until renewal. Housing demand could pick up again. Some buyers paused because rates were too high. This cut may bring back, but demand may not bounce instantly because of affordability issues. For example, in cities where housing has slowed, Toronto, Vancouver, you might see more balanced markets, fewer bidding wars, longer listing times, more negotiation power. On the flip side, sellers in high-demand suburbs might still avoid big discounts because supply is still constrained. Homeowner cash flow. Lower rates reduce carrying costs, adjustable mortgage or renewing. Monthly payments may drop. That gives breathing room. But still, inflation and cost of living remain other pressures. Food, energy, property taxes. So what you should do right now, with over 10 years of experience advising people through cycles, revisit your budget. Factor in borrowed costs, savings, and potential inflation pressure. If renewing soon, lock in when rates drop. If you see favorable fixed-term deals, but don't overextend. Consider splitting your mortgage. Some fixed, some variable so you hedge risk. Avoid taking on new debt unless essential. Even with cuts, debt remains a risk. Build cash reserves. If layoffs or economic shocks hit, you want buffer. Watch inflation, energy costs, trade policy, global shocks. These can flip the picture. Talk to a broker or advisor. You want tailored decisions. These moves won't eliminate risk, but give you control. Forecast on what's next. What do I think happens next for Canada? Another rate cut or two before year end is likely if data stays weak and inflation keeps easing. Bank of Canada has said it's ready, but don't expect a rapid return to low rates. The Bank of Canada will move cautiously, watching inflation, debt, and global risk. Housing markets will likely stabilize, maybe soften in overheated areas. Some buyers will return, especially if mortgage costs drop slightly. However, affordability remains the long game challenge. Even with rate cuts, high home prices, high living costs, and stagnant income growth mean many Canadians will struggle to buy without making big sacrifices. The Bank of Canada cut rates to 2.5%, first cut in 6 months because the economy is weakening. Inflation is easing and risk is rising. This isn't a green light to go all in. It's a warning and an opportunity. You gotta tighten your belt, watch your renewals, avoid debt traps, and make choices that protect your financial future. If this gave you clarity, hit subscribe. I go through videos like this every week so you can stay ahead. I'm Thuc, your money guy, making money simple, smart, and stress-free.